DSCR. What I was going to share to you today was DSCR. I purposely did not bring a presentation on because one, it's not really needed. DSCR is perhaps the easiest mortgage product there is out there in the industry. Has anyone done a DSCR program on Hannah, Alex?
I've submitted one, but I did not go through.
Okay, great. But okay, you've touched up on one though. That's great. Do you guys even know what DSCR stands for? Anna, Alex, I mean, do you guys know what a DSCR stands for? I'm picking on you guys because you guys are the loan officers in the group. I'm not picking on Brenda because she already knows everything.
It's a debt. I can't remember off the top of my head.
No, that's good attempt. Yeah, it's the debt service coverage ratio.
Yes.
Yep. Okay. So do you guys know what that means now? We know what it stands for, but what does it mean? What does that entail? A debt service coverage ratio.
So basically, the income that they're receiving from the rental property can be used towards their DTI or the ratio, correct?
Yeah, exactly. Oh, so yes, for the most part. So in lieu of DTI, debt to income ratio, the mortgage loan will be qualified on the debt service coverage ratio. And as Alex explained, it is the proposed or actual monthly rental value, the rental value divided by the PITIA, the principal, interest, taxes, and the additional items that could be HOA or Melrose. That's about it, right? Because we don't have PMI here in this case. It's a very simple. So let's just say there's $1 million property. Someone does 20% down, right? Your total payment's going to be, I don't know, about $8,000. Let's say that the market rental value for that property is $10,000. Then 10,000 divided by is what? Is it 1.25? I think. Yeah, it's 1.25. Okay. That's your DSCR ratio right there. That 1.25. What does that mean? What does that 1.25 mean to you and I as a loan officer?
One basically means that they're breaking even, and then anything above that is they're making income.
Very good. Right? This is simple math, guys, right? This is why this program's the easiest. Now, with a DSCR, guess what? You don't have to factor in their other income. So whether they are a CEO of a Fortune 500 company, or you are a 32-hour part-time worker gardening, it doesn't matter. Okay, nor does it matter necessarily when we pull that credit report that you have $100,000 in credit card debt. Okay, because again, the qualifying ratio here is not the DTI, but it is the DSCR. That's all they're looking at. So you don't need pay stubs, you don't need W-2s, you don't need tax returns. Okay. You don't need anything. You don't need mortgage statements. So let's just say that Harrison comes and he's an investor, and he identifies a property he loves in La Mirada and he wants it. And let's say he comes and he says, "But I have 20 property investment properties." Okay, can he get this DSCR? Can he acquire his 21st property in La Mirada? Yes. Okay, because they're not going to look at how many properties he has necessarily. I'll get into that, nor how many loans he has, or if those properties cash flow. DSCR only focuses on the cash flow of the subject property. Sounds pretty cool, right? Pretty neat. Now, that's the reason why I don't have a slideshow, but that being said, I'm going to share with you guys Loan Sifter, because when it comes to DSCR, it really is about the structure of that DSCR or that subject property, pending the FICO score, the down payment, and the DSCR ratio, that now will really determine how you're going to sell this program or this product. Okay, because the rates can vary pretty drastically, and how you're going to make income on it will greatly affect how you're going to make income on it. Okay, as you will probably look at more, you're going to have to really look at, depending on the scenario of the subject property, is going to determine whether you want to go with non-del or wholesale. Non-del or wholesale. Now, why does non-del or wholesale really matter? There's two reasons why. Number one, remember, on non-del, we control the file and processing wise. Wholesale, we don't. Okay. And number two, remember, when you wholesale a loan here, okay, you do not work off of a rebate, right? You have to charge your fee, what you want to make in commission up front on that LE. On the non-del side, you don't have to disclose that. You can just work off of the rebate. You can earn both if you want, but you do have the rebate portion. Wholesale, you do not. Okay, so I'm gonna share with you my screen. Any questions real quick before I move forward?
Does that correspond with like also like conventional loans with like
It does,
non-del?
yes.
Okay.
It does. It does. Now, the reason why I bring it up, why I'm bringing this up, is because on the conventional side of things, more likely than not, you're going to go with non-del, right? You're not going to wholesale a conventional loan. But when it comes to DSCR, your outlets for wholesale become a little bit more widely used, okay? More beneficial, okay? So real quickly, if you guys haven't ever done so, we're going expanded here, 30 years purchase. I'm going to just do a $1 million purchase here. 760 was defaulted. We're unselecting first time. We're going self-employed. Doesn't really matter actually, but yeah, actually it doesn't matter. We're going to go DSCR. Okay. Now, under investor DSCR, you'll notice that there's two that you can choose from. Okay. One is DSCR and one is no ratio. Okay. We're going to focus right now on DSCR. Okay. Now, having selected DSCR, you're going to have to put a ratio there. Okay. So I'm going to first start with 1.25 because that is the ideal situation. Okay. Ideally, you want to see the cash flow of a property ratio at over 1.25, 125%. Okay. Oh, let me change this to 75. Okay. You know what? I'll keep it at 80, and I'm going to show you why we're working off of this as opposed to having a slideshow. Do make sure you change the occupancy to investment. Please make sure of that. Okay. And then I'm going to circle and come back to prepayment penalty. Okay. Now, know that loans typically, because it's an investment property, okay, most lenders will default it out at 5-year prepaid. Okay. I'm going to say that one more time. Do note that when it comes to DSCR, and because it's an investment property, okay, following the likes of commercial loans, because commercial loans are generally investment properties or investment loans, there is prepayment penalty. Okay. But for now, I'm going to say none because we like to sell with no prepayment, or most people prefer not to have prepayment penalty. Let me pause. Do you guys all know what prepayment penalty is? Yeah?
Yes.
Okay, good. Okay. So just in case Hannah, who may not know, is if you have a 5-year prepayment penalty, if your borrower sells that loan or pays it off or refinances it within that 5 years, there will be a fee. Okay? Within that 5 years. Now, it is a scaling prepayment penalty fee. So if they pay off in year 1, obviously the fee is going to be more than if they paid it off in year 5. Okay? All right. So let's try this. Let's even see if there's an 80%. Like I said, ideal. Usually it's 75 minimum. So let's do 80% with no PPP. Okay, but a ratio of 1.25. Let's see if we get anything. So we do. Okay, so ARC, Mega, but notice something. Has anyone noticed something here? What's going on? Just a quick glance. What's like a very glaring observation? And I just mentioned it for the past 2 minutes.
The non-deal?
There you go, bingo. Do you notice that most up the top, and if the whole list is going to be wholesale, 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 and we got a non-deal here and a non-deal, right? But you can see that 8 out of 10, if you will, are going to be wholesale. Okay. Now, so for this non-deal, if you want to make a point, you're going to sell it at 7.5. Okay. For this non-deal. At this wholesale, however, okay, if you want to make about a point, okay, it's a little bit better, but remember here, you can sell it at 7.375, but remember, because this one is wholesale, right, you're going to have to disclose on your LE a 1-point origination fee, okay? And then you tell the borrower, hey, I know there's a fee of, call 1 point of 800,000 is $8,000, but because they're going to be getting a lender credit, this right here, this amount's going to go to them as a credit. So you explain to them, I will cover your fee. Okay? They don't really know that the origination fee is necessarily your commission. And you don't want to say that. You just tell them, hey, this is how much this loan program would cost, 1 point. But on the back end, I will be able to cover that for you or something like that. Okay? Now, I want to go back and just change it to a 5-year. Okay? And I want to show you the rate difference. So par rates were at 7, but look at that difference. Now you're looking at 6.5. It's a whole half a point better in pricing just because you changed the PPP to 5-year. Okay, so note that whenever you factor in PPP, your rate is going to improve. Okay, now I want to do this. Let's say we keep the 5-year prepayment penalty and the down payment, but the DSCR comes in at 1. Let's do, oh, sorry, it's just 100. Let's do 1. Okay. Notice that the rate goes up from 6.5 to 6.75 on the par rate. Okay. Now notice if it comes in under like 0.8, you're going to see now it becomes significantly worse or even ineligible. And why? Here it is. This is why 25% down payment is preferred. This is what I wanted to show you guys. If your DSCR is less than 1, okay, most programs are going to require at least 25% down payment. Okay.
I had a scenario I pitched with AAA lending, and it was, I believe it was a 0.8. And they could do it again. It's the loan to value and the credit score, and the credit score just wasn't there.
I see. But you were able to do 20% down payment?
They were trying to refinance.
Oh, okay. I see. I see. Okay. Did you guys all caught that though, right? This is really important. It's DSCR. And so when you are selling and when you are working with a client who wants to do a DSCR program, it is vital for you guys to do your due diligence in trying to find out what the gross monthly rental income is going to be. Okay? Because you need some you need some kind of baseline to calculate the DSCR, because it will fluctuate your rate. Okay? And you don't want to overpromise something and sell, hey, I could get you a DSCR for 7%, when in fact 70% may not even become par because your DSCR is so much lower. That is something we're coming across a lot right now in California. Why? Because yes, rents have gone up, but even on a $10 million or $1 million house, which is not unusual right now, right? $1 million property, you're not gaining $8,000 a month. Does that make sense, guys? Right?
Yes.
Okay. So really quickly, let me just show you guys this. On an average $1 million property, okay, you even do 75 or 25% down, okay, and you sell a solid rate of high 6 right now. Okay, with regular property taxes, insurance might be a little bit low, but even on a 25% down payment on $1 million house, your payment's gonna be $6,000, right? $6,000. Okay. Do you know personally anyone that's paying rent in $6,000? No, because rents don't really go for $6,000. Yes, they've gone up, but they've gone up to, from $2,000 to $3,000, $3,000 to $4,000, maybe $5,000 to $6,000. But on $1 million home in Orange County, you're getting what? A 4.2, right? A nice 3.2 house, right? They're not renting for $6,000. And so even if, let's just say I do find one and it's renting out for $6,000, my DSCR in this case, and with 25% down payment, not 20, with 25% down payment is going to be less than 1 DSCR, 1.0. If it's 20, your payment now goes to the $6,500. So there's no way, there's just no chance. You guys follow? And so right now, the real big issue is getting that DSCR above 100 or 1, right? And getting lucky at 1.25. And so how do we get to that number? The borrower has to do significantly more down payment, right? So now the for me personally, that magic number, what it's been has been 40% down payment. Now you do 40% down payment, right? Your payment's about $5,000. Yes, $1 million homes will go around $4,800 to $5,200. That's kind of the sweet spot. Okay. And even then, again, it's a stretch, but I'm just saying minimum you're doing 40% down payment. Now let's go back here and do 60% LTV, 40% down payment. DSCR, let's just say is 1 with a prepayment, a penalty of 5. Your interest rate is going to be pretty attractive. Look at that. Par rate 6.125, right? So you can sell it at right here and make 1 point or 1.5. Let's just say you make a 1.25 at 6.5, right? You go back to this. Oops. You go back to this, and now you're selling at 6.5, and your payment's a little bit better, right? So just like any other loan, right? The key is more down payment, and you get right. Did you guys know that par rates for DSCRs can be as good, if not better, than your conventional loan, right? Did you guys know that? Now you see it though, right? So obviously the key is down payment. Okay. Now,